You think you're being a safe, responsible investor. You're following the advice of every major financial outlet. But what if I told you that this safe strategy just cost a group of retirees over $1.2 million? And chances are, you're making the exact same mistake right now. Welcome to the channel. In this video, we're exposing the catastrophic failure of a classic investment approach and showing you the proven alternatives to protect your wealth. This isn't just theory, this is a real-world cautionary tale with a 7-figure price tag, and you need to see it before it's too late. Stick around, because by the end of this, you'll understand exactly how to adjust your portfolio to avoid this devastating pitfall. So what was this so-called safe strategy? It was an over-reliance on bonds and fixed income assets. For decades, the golden rule for anyone nearing or in retirement was to shift your portfolio out of risky stocks and into the safety of bonds. The classic 60-40 portfolio, 60% stocks, 40% bonds, was hailed as the perfect set-it-and-forget-it solution. But in the last few years, that strategy didn't just underperform, it collapsed. And here's why you need this information. Because the financial landscape has fundamentally changed. The rules that worked for your parents' retirement simply do not apply today. Blindly following old advice is now one of the most dangerous things you can do with your money. Let's break down exactly what went wrong, point by point. First, the interest rate illusion. For over 40 years, we were in a sustained bull market for bonds. Interest rates consistently trended down from their peak in the early 1980s. When interest rates fall, the value of existing bonds that pay a higher rate goes up. This created a massive tailwind that made bonds look like a no-brainer. Investors got lulled into a false sense of security, believing bonds would always provide stability and steady income. But that 40-year trend is over. The period of ultra-low interest rates has ended, and we've entered a new era of higher for longer rates. And when rates rise, bond prices fall. Hard. This leads directly to our second point, the historic bond market crash of 2022. This was the wake-up call that shattered the illusion. In 2022, the Bloomberg US Aggregate Bond Index, the core holding of most safe portfolios, fell by over 13%. That might not sound catastrophic until you realize this was the worst year for bonds in modern history. Even during the 2008 financial crisis, high-quality bonds actually went up in value as stocks crashed. They did their job as a diversifier. But in 2022, both stocks and bonds crashed simultaneously. The classic 60-40 portfolio had its worst year since the Great Depression. The safe part of the portfolio wasn't safe at all. It amplified the losses. Now, let's talk about our cautionary tale. Meet Robert and Susan, not their real names, but a composite of a very real situation. This couple, like many, had diligently saved throughout their careers. They retired with a nest egg of $1.8 million. Following conventional wisdom, their financial advisor had them in a 40% stock, 60% bond portfolio. They thought they were playing it safe. Then 2022 hit. Their bond allocation, which was supposed to be their anchor, dropped by nearly 14%. Their overall portfolio lost over $400,000 in a single year. But the damage didn't stop there. This is the third and most brutal point, sequence of returns risk. This is the danger of receiving poor investment returns precisely when you are beginning to take withdrawals from your portfolio. Robert and Susan, now in their early 70s, needed to take their required minimum distributions and living expenses from their shrunken portfolio. They weren't just losing money on paper, they were forced to sell assets at depressed prices to generate cash. This permanently locks in the losses. The math is terrifying. If you lose 30% of your portfolio, you need a 43% gain just to get back to even. For a retiree taking consistent withdrawals, that mountain is almost impossible to climb. The initial $400,000 loss, combined with continued withdrawals in a down market, is what ultimately led to a projected long-term loss of over $1.2 million in future portfolio value. That's the real cost. Fourth, we have to talk about inflation, the silent thief. even before the 2022 crash. Bonds were struggling to keep up. For years, the yield on a 10-year Treasury note was below the rate of inflation. This means that if you were holding that bond, your purchasing power was actually decreasing each year. You were guaranteed to lose money in real terms. So-called safe investments were systematically and quietly making you poorer. This is the opposite of safety. Safety isn't just about avoiding big dips on a chart. It's about preserving and growing your ability to buy groceries, pay for healthcare, and enjoy your life. A portfolio that can't outpace inflation is a portfolio in terminal decline. So what's the alternative? What can you do to avoid becoming the next cautionary tale? This is our fifth point: modern portfolio construction. The old model of simply splitting your money between a S&AMP, P500 index fund and a total bond market fund is broken. You need a more nuanced, resilient approach. This involves incorporating assets that have a low or negative correlation to both stocks and bonds. Think about things like Treasury inflation-protected securities, or TIPS, which are specifically designed to protect against inflation. Consider a strategic allocation to real assets, like real estate investment trusts or commodities. And for a portion of your equity holdings, look beyond the US to high-quality international and emerging market stocks for true diversification. Sixth, don't fear all stocks. The key is owning the right kinds of stocks for this new environment. Many retirees were taught to flee from equities entirely, but that's a mistake. You need growth in your portfolio to fight inflation and ensure your money lasts 20, 30, or even 40 years. The solution is not to avoid stocks, but to be selective. Focus on companies with strong balance sheets, consistent profitability, and the power to raise their dividends year after year. These quality dividend growers can provide an income stream that actually increases over time, unlike the fixed payout from a bond. This is a powerful hedge against both inflation and market volatility. Finally, this all leads to the most important takeaway. You must be the CEO of your own financial future. You cannot set a portfolio on autopilot and expect it to navigate a world of changing interest rates, geopolitical shocks, and economic shifts. This doesn't mean day trading. It means conducting an annual review of your asset allocation. It means understanding the role each investment plays in your overall plan. Is it for growth? Is it for income? Is it for stability? If an asset isn't fulfilling its role, like bonds did in 2022, you need to have the knowledge and the courage to make a change. The story of Robert and Susan and their $1.2 million mistake is a painful one, but it doesn't have to be your story. The financial world has changed, and your strategy needs to change with it. Ditch the outdated dogma and build a portfolio that's designed for the world we live in today, not the world of 40 years ago. If you're ready to take control and learn the proven strategies for building a durable, growing retirement portfolio that can withstand any market condition, then you are in the right place. We break down complex financial concepts into actionable steps every single week. So, do us a favor, hit that subscribe button and tap the notification bell so you don't miss our next video. It's time to stop following broken advice and start building real, lasting wealth. See you in the next one.